Welcome to the Broken Pie Chart Podcast, episode 179. I'm your host, Derek Moore, and back with me is my semi-permanent co-host, CEO of Zega Financial, Jay Pestrichelli. How you doing today, Jay?
Good, Derek. Good. I know we're recording on a Friday. It's a sunny day in the summer. Mood is up. No doubt about it.
Mood is up, market's up, and some good. By the way, before we get into our contents, we're going to talk about is this or isn't a recession? Somebody's wrong, somebody's right, Fed or market. I'm going to debate about stagflation. We're going to do earnings and how the market discounts everything. Who's right, the market or everybody else? But I got to tell you, I know you've been watching a show and it's under the radar because it's not like, I don't think people have seen a lot of ads for it and stuff, but it's what's it called? The Bear.
It's called The Bear.
And Hulu. Yeah. It's really good. Really good, Jay.
Yeah, I stumbled upon it and you stumbled upon it independently. I know you and I usually share, good shows with each other, but we both watched it and, really happy. I heard it's been re-upped for the next season too. So just the first season's out. And if you haven't watched it, it's, a show about kind of what goes on in a sandwich shop kitchen. And, as a guy that, before working on Wall Street, worked in a restaurant and my family owned a restaurant for a gazillion years, I found it really, really fun to watch and accurate and all the things that can go wrong during the day. It's just really entertaining show.
Actors are very good in the show. And what I like about it too, so I watched it on Hulu, and even though Hulu runs a commercial, I think the beginning, which means I don't have the upgraded, commercial free, but they're really only 25, 27-minute episodes. So you can blow through.
Yeah, they're quick.
Season. Yeah, really quick, right?
Yeah, my whole family watched it, right? We all watched it together, and it was easy, right? The teenager kept his attention span just fine. So it's they go quick. It's great.
Yeah, so that's a strong recommendation, I think, from both of us. We'll pound the table, as we used to say. I don't know. Does anybody even know what pounding the table means anymore?
I mean, I these days it's when I wake up and I watch that the market does something completely opposite from what I expected, I may pound the table, but that's about it.
Back in the day, it was the analyst, right? So the analyst would be like, "This stock is a strong buy," and they're slapping down on the table, pounding the table,
fist pounding the desk. Yeah, fist on the desk. Yeah.
I think I've seen Kramer say that as well. I think he said somebody's pounding the table on that. By the way, Kramer is apparently a fan of the Bear as well. He's been calling people chef, which that will make sense if you watch it.
Yeah, that is one of the things about when you work in a kitchen. It's a term of respect. You call everybody chef because they're doing the work. How you doing, chef? Okay, chef. Behind you, chef. And that's kind of a real thing. If you ever worked in a kitchen, that's you do that.
All right. Well, as we switch here, by the way, the topics for the show, I get emails. I like getting emails. Derek.moore@zegafinancial.com. That's DEREK.MOORE at Zega. Z as in zebra, E as in Eddie, G as in George, A as in Apple. Financial is up to you to spell correctly. Jay, one of the questions I got is, okay, wait a second. I thought negative 2 quarters in a row or 2 quarters in a row with negative GDP was a recession. But now, and I think a couple people said, well, the White House is saying it's not a recession. Other people are saying it's not a recession. I can give you the technical definition, and I'll give you the real things that people look at. But I want to point something out to the audience. 2001 was a recession. And we did have 2 negative GDP quarters. They were not consecutively. 1956, 2011 had 2 non-consecutive negative quarters, but were not considered recessions. Jay, I don't know if you want to start with this, but I'll just throw it out. Negative 2 quarters of negative. It's not a recession.
Oh yeah, I mean it's become like everything these days. It's become politicized. And are we in a recession? We're not in a recession. I mean, to me, it's I always boil it down to 2 things, but it's a behavior thing right now. Like our companies acting as if we're going to be in a recession, and our consumers acting as if we are in a recession. Meaning, usually that indicates spending less or concern about their jobs. Tightening up the purse strings. that type of stuff. And I think there's probably a little bit of that going on just from, just even at Zega internally. There's some things we said, let's hold off on that spend for a quarter or two, right? Derek keeps asking me for his own Bloomberg machine. So, Derek, we're in a recession. You can't have a Bloomberg machine yet.
Yeah.
But besides that,
Content will be so
I
much
would,
better, Jay, for the Bloomberg. Go ahead,
all
though.
joking aside on that, I almost feel like who cares? Like, why do we have to put a label on it? I get back to, I understand you want to, have an idea of what the economy is doing, but the stock market doesn't always equal the economy, right? The economy usually lags, in my opinion, the stock market. The stock market historically is a leading indicator. And, if the things that matter, like corporate earnings and interest rates, are showing a recession, then great. The market will act as if spending is going to slow down and corporate earnings will drop. But to me, I always bring it back to those two things. I know I'm pounding the table, chef, on this one. Look at that, I just used two references in one sentence. On this, that it doesn't matter it doesn't matter what you want to label it. It matters as to people's behavior and what does it do for corporate earnings and what does it do for interest rates.
Yeah, to me, I agree. And I always bring it back to an individual. Let's take, somebody living in random state USA and says, what matters to them? One of the biggest things for them is, do they have a job? Are they employed? And what is the probability of them being employed going forward? Okay, that's really crucial for somebody. The second is, after inflation, do I have more or less buying power with my money? They call that, and in economic speak, real personal income less transfers. By the way, that's one of the two biggest things the National Bureau of Economic Research, or NBER, uses when they determine what a recession is. So that's the official arbiter of recessions. And the other thing with them is, in past recessions, you look on charts and you have a nice little shaded area. You're like, oh yeah, that's the start of the recession. That's the end of the recession. Sometimes they'll tell you were in a recession 7 months later. And sometimes they'll tell you 5 or 7 months later that you're out of a recession. So to me, bringing it back to the individual, do you have a job? What's your buying power? And these are the two biggest things. Because if we don't have...
Yeah, I'd almost, would you agree the recession moniker is a lagging indicator, right? Based on what you just said.
Yeah, I think so. COVID was probably the only time when you looked in a tunnel and saw a light and said, that is absolutely a train coming. It was purely obvious, because when you shut down the economy, all right, you're going to have a recession. But right now, I don't think it's clear. Now, Jay, I'm sure you would agree too that if companies start acting on this, the self-fulfilling prophecy, and they start doing layoffs, they start cutting back, they start capital expenditure, declines, that could be, it could be a consequence of this, right? We don't know yet, but right now, no.
Yeah, the market can talk itself into a recession. Yeah, it almost did it in Q4 of 2018, right? Same thing. We didn't have one, but the market, that 20% sell off or 19.9% sell off, everybody was fearful that we'd talk ourselves into a recession, and there was none.
The other thing I think that, 2001, you and I both remember that we did not have 2 consecutive quarters of negative GDP growth. It was absolutely crystal clear that the economy was, I was going to use another word, but we don't want to get the explicit label on the podcast. The economy was going down the toilet, right? It was clear to everybody. That was a recession, right?
The bubble popped, right? Right, it was there was a huge bubble, huge run up. Okay, it made sense. And the popping of the bubble left over some decent earnings for companies, right? The survivors of the .com bomb kept things afloat. But you're right, it was a major reversal of the economy, no doubt about it.
So tie a bow on this before I move on to something else. The two main things are real personal income, less transfers. That's just a fancy way for saying it's the income that you get from being employed, not from a stimulus check from the government or unemployment checks or any government benefits, and non-farm payroll employment. So these are the two major ones. There's 1, 2, 3, 4, 5. So there's like 6 other things. I won't read them off. I did a podcast on this a few weeks ago where I actually detailed all these. But as far as, the other thing is politicians will say and do things that may or may not be true. And obviously,
What?
yeah, I know it's
Are
shocking.
you
I
kidding
should.
me? Whoa. Be careful with what you say here. Scathing
I
accusations,
know I'm not
Derek.
really going out on a limb. So I think when the White House or their spokesperson, I forget the gentleman's name, came out and said, yeah, we're not in a recession. People were skeptical about that because 6, 7 months ago they said we peaked inflation and all that stuff. So, but none of that stuff matters. Remember, only think about random person, random city, random town in the U.S. and what's crucial to them, and that really tells you beyond the noise, anything. But I think, Jay, the other thing right now is we're hearing the stagflation word. And I look at this a little bit different than some other people. But stagflation got its name from the 70s. And in the 70s, so there's a Keynesian economist, and Keynes or Keynesian economist, that's a branch of economic people, for lack of a better term. There's the Chicago School, there's the Austrian Economic School, and they just have different views on the economy. And the conundrum that came up from the 70s and where it got its name, it was thought of as it doesn't make any sense that you could have uh, rising inflation with lower economic growth. Because in the classic Keynesian thing, it's like, oh, if there's prices go up, demand goes down, and you fix prices. And so they call this stagflation. And the consequence of stagflation is typically prices going up. So if you, I'm not going to do the whole critique of or the explanation of, remember, the supply to the sky. You draw the one line, you draw a crossing line, demand to the dirt, and you have equilibrium where supply meets demand. And so the idea is if prices go up or if supply, anyway, I don't want to get into that, but that's where it comes from. And the Keynesian economist really, I think they always view things through the demand lens, that it's always a demand problem. And I think that's what you saw this time, and why stagflation-ish or stagflation is what we have right now, because it was a supply shock. It was a problem with supply, and it was also increasing demand with stimulus checks at the very moment supply was sort of impaired. So I think that's the other debate, and I think it's a lot more nuanced, Jay. I don't know if you have any thoughts on this.
Yeah, well, I mean, you have your professor hat on for a moment here, Derek, and I appreciate that. But when I hear the term from a layman's perspective, I think stag means stagnant, and inflation means inflation, right? So no growth with higher inflation, right? There we have discussed internally at Zega about there's a labor component to that, right? No, people aren't earning more because less people are working, but that's the way I think about it. And I can appreciate the official definition or the Keynesian definition of it, but when I think we're going to talk about this in a little bit. Clearly, inflation is up, right? That no argument on that. But are we stagnant? Are we really? Are we flat on growth? Right? I don't know. I don't see that, and I think we'll get to that a little later in the discussion. But again, I go back to the doesn't matter to throw a term on the status of the economy when we're trying to make investment decisions over the next 1, 3, 5 years. And I'm not sure it does. I really don't think it's all that relevant, especially with what you just said. That I don't think people feel a lot of pressure in their pocketbooks right now.
Yeah, I think the challenge for a stagflationary environment is really, what can the Fed do? It's the worst outcome, or it's the worst current situation for the Fed to deal with, because raising interest rates at the same time you have slowing growth, it's problematic, because normally you rise interest rates and it's going to slow growth because it's supposed to stop demand, right? But
Right, right,
so
right.
they're in a little.
It is I agree. It is a conundrum for the Fed, right? I mean, only Volcker had to deal with it before, I hear, but
Yeah,
and everybody remembers him for what he did.
no, that's right. So I will say too that when we look at GDP, and I'm going to call it's not a party foul, it's some sort of foul. I'll think of it where GDP comes out and it's negative, and then people start to explain, oh, it's okay because it's only negative because of this. Oh, that's only a one-time thing. So GDP, I mean, really, what the problem was in Q2 is everybody probably overordered stuff. Just keep ordering. We'll see which package arrives first for our inventory. And I think you saw it with Walmart. But residential, the two culprits really were change in private inventories. So GDP was minus 0.9%. Change in private inventories was minus 2.01%. So that obviously was a big thing. That means companies are not, ordering as much stuff. And it was the same thing in Q1 as well. And then you have residential investment.
Yeah, both of those reasons, right? I guess to remind everybody, right? This technically, from a GDP perspective, we've had two, negative quarters consecutively,
That's
right? We don't have to go back to the recession conversation, but both times the culprit has been inventories, right? And as you just pointed out in the equation, if you've overordered and you haven't sold enough, that hurts the GDP calculation.
What is a little bit fascinating is in Q1, net exports were down 3.2%. This time, and I think it's probably, I'm guessing, and I think I'm pretty good at guessing this stuff because we're shipping liquefied natural gas and some other stuff to Europe. This is just my opining in real time. Net exports were positive 1.43%. So I don't want to drag us down into a minutia of the GDP, but I am not a fan of them saying, well, if you look at GDP X exports, okay, now let's leave exports in, but let's take out private inventories. It is what it is. But yeah, on stagflation,
There's a reason all those things are included in the number, right? I mean,
that's right.
like you said, I agree. It is what it is. You keep it all in if you want consistent definitions. And I guess I think you went here is because I was, starting to hint that, maybe we don't have stagnant growth. I'm guessing you went there because of the GDP decline.
Correct.
Right? Like, hey, if you use GDP as your measurement of growth, we have negative growth. The economy's had negative growth, right? I think that's your point.
No, that's exactly right. And by the way, I would say, is there that much of a difference between minus 0.9% and plus 0.9%? I don't know. I mean, that's a little change in exports. That's so I think we want to move on from this, but I think we do have slowing growth. I think that's clear. But anyway, it's back to the job thing. Here's what I want to get to next, though. Let's move on from this. Somebody's right, somebody's wrong, the Fed or the market. And there is a disconnect between, I think, what Powell said and what the market thinks he said. And let me kind of frame this way. The Fed comes out with their statement of economic projections. They didn't do a refresh at this meeting, but the last one was the June meeting. And they basically say, hey, all committee members, what do you guys think the Fed funds rate is going to be in December of this year, at the end of the year, at the end of next year, at the end of the 24? Okay, great, we have that. What do you expect PCE? That's their preferred measure of inflation. Okay, so I was looking at a chart I found, and basically the Fed funds futures, which tell us the implied future Fed funds rate, that they are much lower
as per the market.
Basically, the market's saying,
Yeah,
yeah,
right.
Like the market's saying, okay,
that's a real capital traded pricing, right? That's real money taking a position, right? It's not a theoretical projection like what the FOMC members are doing. This is what the market is saying, right? Is that the difference here?
And basically the market has their expectation through actual trading that the Fed's funds rate will be much less than what the Fed has said in their economic projections. We know that they raised 75 basis points and interest rates dropped. So this is to use Greenspan's term, a little bit of a conundrum. Somebody's wrong on this and somebody's right. And if the market's wrong, then the Fed is going to continue to raise rates. They're going to continue to stay on their path. And in fact, because PCE is running hotter than their initial projections, you can make the argument, I'll take this side for a second, that Fed funds futures projections are too low and the market has it wrong. Jay, on the other side, though, the market sort of discounts stuff, right?
They do. They do, right? The market, so, it is a great question. Which is right, the Fed projection or the market, and they are different. Different to the tune of, like, when you look at, say, 2023, the market has Fed funds at somewhere around 2.75, but the FOMC members are, the median is 3.75. So it's a 100 basis point difference, and not a single, I'll say, vote, not a single opinion from the FOMC is at or below the 2.75 where the market is. Like, the lowest one there looks like a 2.8 maybe, right, or 2.9, and it's it's a vast difference. The divergence between the projection of the Fed and what the market is planning on. It's if the market is right, then the Fed will. So what is? I guess I'm going to go to what this all means. If the market's right, it means that the Fed is done raising rates, right, at this point, right? Rates drop. The Fed has to lower rates. We could interpret what that means, but let's just stick with that point, that the Fed's going to lower rates. But if the Fed's right, they're going to continue to raise rates. And so, it's very different. That it's very interesting to me that who do you believe, right? Do you believe what's said from the Fed, or do you believe what's traded by the market? Hard to know.
I mean, they've done 75
I typically
bips.
lean towards the market.
They've done 75 bips 2 meetings in a row. That's big.
It is big. And by the way, the market thought that well before the Fed did it.
That's right. That's right. And for a while, it was 100 basis points, and the Fed funds futures actually backed away from that probability and came back to 75 basis points. Jay, let me ask you a question, though. So I use the inflation nowcast from the Cleveland Fed. Nowcasts, of course, are only looking at every bit of data that comes in. But it's been pretty good over the past several months. Their forecast for the July CPI is 8.82. That will be released, I think, around August 10th, August 11th, somewhere in there, August 13th. Their PCE for July is forecasted at 6.65. PCE is going up. If they do get an 8.82 CPI, that would be down from the 9.1. But if those numbers bear out and we get those numbers next month, is the market like, yeah, no, we're good. We're good. No, interest rates can stay where they are or in fact go down? Like, I have a hard time believing that. But what do you think?
I think the market is really anxious to predict peak inflation, right? It misstepped on the May number and got it completely wrong and thought, the market had peaked out in, April, and then May came out and the market was like, whoa, inflation's higher again, right? So I think the market is really looking for a sign of peak inflation before it really makes a commitment. And, a flat to slightly down CPI number in July versus June might give the market that sense that we've topped out. But I believe that the Fed is probably going to look for a trend before they change their mind. So again, I think the market will jump the gun, right or wrong. Definitely was wrong in April. The way that the market interpreted peak inflation. So the market got that wrong, and then reacted dramatically after that May number came out. So if you ask me what the market's going to do, I think it's going to jump the gun. I think it looks as an 8.8 of going, look, they're going to say things like the law of, you're tracking year over year changes because inflation ran up so much. It's so hard to increase another 9% on top of, record high that we saw a year ago. Obviously, it did get higher, but at the time it was high. So I think the market will probably jump the gun and react bullishly. I think and the same thing will happen with rates, where the market will say, look, Fed's done its job. They're done raising rates. And I think, by the way, that's priced in what we just discussed about the 2023 projection. So that's, I think, if we come in flat on those numbers. And I know PEC up isn't really the interpretation. But the first number comes out. It's next week, right? It's the first week or second week of I don't remember the date of July CPI number. I know it's on our list of important dates to watch.
I think it's around August 10th. I should have looked it up, but it's usually around there. Yeah,
somewhere around the 10th day. So I think that you asked what I think. I think the market will jump the gun if they see a number like that. By the way, on the forecast number, you're right that those guys have been definitely accurate on direction. I think their magnitude has been off from time to time. Of course, it's so hard to nail those things. But I think directionally, the now forecast has been pretty accurate in direction. So I would agree with you on that. Just maybe not the magnitude of the number.
Well, here's this. I'm going to let you know who's right and who's wrong 6 months from now, because that's
okay.
What we'll know.
Yeah,
okay?
I think so far I say market has been right. You know what I mean?
Yeah.
So far I've said that. Look, I don't. Gosh, I think it's a little healthier if we could stabilize with higher rates. I'm kind of rooting for not that I want rates to go higher because of everything that implies, but I'd prefer to have a Fed funds rate at 3.5 versus 2.5, right? It just makes for a more even keeled investing environment for everybody, whether you're conservative or aggressive, right? If you really want to take it back to what we're trying to do day in, day out, which is helping people invest to meet their financial goals, right? Then I think it's a healthier environment, right? It's historically low rates and can inflate stocks.
Jay, when they appoint me head of the Fed, and I go in a time machine, and of course I should be the head of the Fed. I don't know why I'm not. I don't understand.
Yeah, I don't know either.
Yeah.
Maybe you haven't asked yet.
Maybe that's the thing. I just have to ask them. And by the way, I don't have a PhD, and Powell does not have a PhD. So normally that was one of the sort of dividing lines. So I would, if I could go back, I don't think it's been healthy having 0% interest. And obviously, I don't want to get into all that. But to me, like 2013, 2014, 2015, like why didn't they just come out and say, hey, we're going to raise this year a quarter point, and then we're going to look in a year and just see what happens. Like that would have been so smart to me. They could have done it. And instead, we had the taper tantrum.
Do you remember how the market reacted in 2013 at just a hint of raising rates?
Right, but they didn't message it right. There was no, hey, we're going to do a quarter point, and that's it. They could have done 0.125 from zero.
Yeah, I mean, that Bernanke caused the taper tantrum, right? And that was, the market was like, don't do it. Don't do it.
I mean, Jay, if you would have said, hey, we're going to do a quarter point a year, and if we don't think we can raise, we won't. It's data dependent. It would have taken 8 years to get back to 2% Fed funds. I don't know. All right, let's bring this to earnings, though, because earnings, you and I have been talking about this for a while. And here is where I think the commentators, the prognosticators, and everybody else has been overly bearish and not just looking at the numbers. And everyone's saying, oh, wait a second. Earnings are okay, but wait for that shoe to drop. So, Jay, I think earnings so far, and according to, I'm looking at a Refinitiv S&P 500 IBS earnings dashboard, 246 companies in the S&P have reported, 256, I think, are remaining. If I can read that right, it's around there. Jay, so far earnings?
Somehow you've got 502 companies in the S&P, but that's okay. We know it's somewhere around there. Half have reported, let's say.
Well, isn't Alphabet A and B? Isn't that two companies?
Yeah. There's definitely two Googles in there. That is true. So I think it's 501. It might be 502. Yeah, I think you're right.
So Jay, you and I have been consistent. Said so far, when everyone else has been bearish, we pointed out earnings are still going up. I'll set the stage here, and then I want to turn it over to you, Jay. S&P, and this is blended for Q2, looking at everybody who's reported, and then the estimates on the remaining ones. 7.6% has been the year-over-year growth in the S&P, revenue up 12.1%. And I think 76% of companies that have reported have beat their estimates. So far, earnings are holding up. And you and I have always said, and you've been talking about this, as have I, to different advisors and clients and on air, it really comes back to earnings. Earnings are what matter, right?
Corporate earnings definitely matter. right? It's interest rates and earnings, pound on the table, right? So yeah, and it looks like from a historical perspective, when you talk about who's above, right, it's 70, would you say 76%
Correct.
of those companies have beat estimates. That's normal, right? I mean, CEOs usually kind of sandbag a little bit, and analysts, follow that too. It's easy. It's nobody wants to overestimate, but historically speaking, what 67% beat
That's right.
estimates, right? And so we're exceeding that by almost 10% right now. So all of those lowering and reductions of estimates turned out, maybe that was too much of a reduction there. So and the other data point that you said that I want to really highlight: earnings are up 7.6%. Earnings are up 7.6%. Um, I mean, that's corporate growth, right? Companies are making more money now. Now, you did point out an interesting another data point that revenue is up 12, right? So if revenue is up 12, but earnings are only up 7.6, what's that mean? It means a little bit of margin compression, and it means that it probably means that their costs are going up a little bit, but they're still growing. And so I think that, to me, that's one of the most important things to pay attention to when you're trying to figure out, is this a good market to be invested in or not? Should I be on the sidelines? Should I be in cash? Or should I be, exposed to upside, equity exposure, right? Because of, whatever the environment is, right? So all the stagflation and all the recession talk, you still have corporate earnings growth.
Yeah, that's right. And I hear people trying to go against this, and they point out that year over year, energy earnings are up 264%. Financials are the worst; they're down minus 22%. And if you take out energy, then you actually have negative by a few percentage points year over year growth. I take issue with that because you can't cherry pick it. It's an index, and they aggregate all of the companies. In fact, Professor Jeremy Siegel, who teaches Wharton, Stocks for the Long Run, which, by the way, I pre-ordered a copy. I think it's coming out in September. I'll put a link in the show notes. He's reissuing an update on that book, which I like because he has all that data in there. Just for the data alone, it's worth it. But he makes the argument too. He points out 2008, a lot of companies, wrote down everything, and they just, you know, I think they had negative earnings in 2008. But they're aggregated. It's a weighted index, but all the earnings are aggregated. So I do not take bits and pieces out. It is what it is. And yeah, Jay, it's growing. It's growing. And what that tells me, though, is they've been able to pass on some of the price increases to their end buyers. So that's good to me. And if earnings hold up,
That's good. Yeah.
I mean, this to me is all really good news. And I think this week, when we saw Amazon and Apple and Google and Microsoft, who had some misses in there, but gave some forward guidance, and the market rallied. Jay, this brings me back to, I think, there's really four different scenarios. But in the end, like, the market a lot of times discounts everything that's out there. And I mean, we'll let you know in 6 months, but the market is saying, we think earnings are holding up. And we believe the growth story in corporate earnings. And by the way, March of 2009, things were not great, but the market bottomed. Like, the market gets ahead of this stuff, Jay, right?
Market. I always say the market, leads the economy by 6 months, right? The market's, similar to my comment about what's happening in the bond market, right? Like, the market's going to jump the gun on this. They'd rather be early and right, even though sometimes they're early and wrong. I'm with you, right? The market is definitely liking this. I will add though, when you think about Q2, right? What are the months? April, May, June that are included in Q2? We've said internally, it's really Q3 that's going to show if behavior has changed, right? Because the real fear, didn't quite hit the market, I think, until the beginning of June. And so, you only got 1 month of, real recession talk, serious recession considerations, serious slowdown considerations in everybody's dialogue in June. So, I do think Q3 is going to be the real stick in the mud if it comes up short, if we have a lot of misses there. But, we're 3 months away from that. I don't want to discount the good news that we're seeing today. It's good to see that the activities of, the first half of the year didn't bring down earnings for companies in general. There are some interesting misses, right? And I think it goes back to your conversation about managing supply before. When you look at, say, Walmart, right? They haven't reported yet, but they pre-announced that things are not going to be great. You look at Intel, which reported, a day ago from the time of recording this, Thursday, really missed on earnings. So it's becoming a little bit of a stock picker's market. But, some of the big guys that you just mentioned, Amazon and Apple, heck, I think Apple said in their conference call, they see no signs of a slowdown. For Apple to say that to me, that was pretty impactful to hear Apple say that.
Yeah. No, I agree. And by the way, our one of our fellow investment committee member at Zega pointed something out to us this morning that just blew my mind. So I'll bring it up. Intel has not gotten above their March of 2000 high in price. Obviously, they've been paying dividends since then, but that blew me away, Jay. I'm like, really?
Yeah, Intel's getting its lunch eaten by AMD and NVIDIA, in my opinion, right? These days, they seem to be a fundamentally, Intel's weaker to those two right now. By the way, NVIDIA is in the top 10 weighting. I think it just replaced Meta, formerly known as Facebook, in the top 10 weighting in the NDX, I believe, right? So there's definitely some, you could say Google and Meta have similar models, ad models, but those two stock charts look definitely different. Again, pick your stock, pick fundamentals. If you don't, we typically don't try to pick them, right? We say the index is a better deal and it kind of does the weighting for us automatically. But if you want to take a shot at those things, you can find some real dogs in there and you can find some flyers.
Intel, by the way, was the sixth highest weighted company in the NDX in March of 2000. I think, Jay, I looked this morning and it's somewhere around 47. Meta, Facebook. By the way, I'm curious. There's a guy who was operating a company with the name Meta, doing like virtual reality at concerts. He's suing them now. I thought that was interesting. Those are always interesting to me.
It seems like an easy payoff.
Yeah, I guess the lawyer was on CNBC. I mean, I know nothing about it from what I saw on CNBC, but it sounds like the lawyers and they've been going back and forth and couldn't come up with something. The other thing, you're an Android phone person. I'm an Apple person, although I've had Androids in the past. I do wonder, like, Apple has the setting where you can basically say, I don't know how it works behind the scenes, but it doesn't allow Facebook to track you as much or some of the pixels on the websites. I don't know that much about it, but I think they mentioned that in their earnings call. All right, Jay, let me just transition. If you think about when you watch Sesame Street and there were the four boxes, upper left, upper right, bottom left, and it was like one kid playing basketball and the other three playing football. Which of these is not like the others? That's not what I'm doing, but I want to think about the quadrants. And the reason why I bring this up, when we think about the two things right now, it's earnings per share and it's inflation. And I think you and I would agree the worst case scenario is earnings per share, earnings go down, net income goes down for the companies, and inflation continues to go higher or stays high. I think I'll leave it there. The best case is earnings keep going up and inflation keeps going down. And I'll remind our audience, inflation going down doesn't mean we don't have inflation. It goes back to two. We still have inflation year over year, and the price increases that we've had don't necessarily come back. So these are already embedded in. But Jay, those are the two obvious scenarios. And so far, though, I think we have earnings per share up and inflation up. And I think that's where we are, right? I mean, what do you think about I guess I didn't read all the.
Yeah, if I'm thinking of your 2x2 there, right?
Yeah.
If earnings per share are up, I think as we just talked about that a second ago, yeah, I think you could, for now, not consider the current status of things to be earnings down. So if you got EPS up and you've got inflation, up to flat, I feel that's pretty obvious as well. The inflation down, right, or decreasing of an increase, right, like a slower increase in inflation. I don't think that's the case yet either. we talked about the market maybe jumping ahead on that. But for now, with EPS higher and inflation inflated, yeah, I mean, that's clearly the situation we're in, so it's not the best situation. It's not the worst situation on that 2x2 that you're talking about. So I guess the question is where you were going is the market fairly priced for a scenario where inflation is high and earnings per share is increasing, right? I guess maybe that's what you're throwing out. And I think you're probably proposing that, yeah, it's probably about right where we are right now.
I think so. I mean, we always go back to, we talked about when the market goes up or down, you could have PE ratios or forward PE ratios going higher and earnings staying the same or going down. You could have earnings growing and the multiple compressing. And that's exactly what we've seen over the last year. In fact, over the last 2 years. People forget last year, the market was up, but most of that was not due to, multiples rising. Give you a thing that, so far, this is JP Morgan's Guide to the Market, Jay, minus 14% ish, 14.6% S&P price return. Earnings were up. This is their number, up 5.9% year to date. Multiple growth was down 20.5%. The year before, multiples was down like 8%, I think. So,
and look, that's kind of consistent what we talked about a minute ago, that revenue may be increasing, but earnings aren't increasing as fast, right? You got some margin compression there, and you have a multiple compression there, right? These are definitely related, and once again, I would say plus, market is getting that one right.
Yeah, it's interesting on JP Morgan's thing too. Their EPS, so it's tough to get the exact number. They have a couple bars, but 2022, their consensus analyst estimates for this year are below 225. They're below the street. Next year is, I don't know, maybe 235 to 236, 240. I can't get a number exactly. I don't know. I mean, I think in some regards, are projections by some of these banks too bearish? I mean, I think the thought was earnings have to come down, but we just talked about they haven't yet, and this is all multiple
They
compression.
haven't.
So yeah, I agree, Jay.
Yeah.
I think you can make the argument that I mean, we're fairly priced, and earnings don't have to go up for the market to go up. The market's multiple could just increase, and it'd be nice if earnings keep going up and the multiple re-rates. But I mean, what are we at right now on a forward PE basis? I think we're only right around 17. So we're right around 25-year average. So that's not crazy at all.
Yeah, I mean, it's not expensive, right? It's from a fundamental perspective, it's not. So I don't think anybody would consider it expensive. So let's ask. I'm going to throw a curveball at you a little bit here. So let's say the market's right and rates go down, right? We're not sure why the market's projecting that. I think common knowledge would say, or conventional knowledge would say, oh, the market's working in, a recession and the Fed has to cut rates. But, right, I mean, that's kind of conventional wisdom of what people think. But if that really happens, lower rates are stimulative and good for the market. And so, like, well, which one of these things is actually going to happen, right? Can we have the Fed cutting rates into an environment where earnings are on the rise, and you've got multiple expansion, and then you've just, I've always believed that as rates go down, markets, stocks go up, right? That's been kind of the whole no other, there is no alternative to invest, right? If we go back to 2.5%, is that really worth it if you're under inflation? No, you've got to invest in stocks. So, I don't know, like if we see so here's let me clarify the question to you. So now that I've kind of laid out the broader spectrum. So if we see rates drop that the market is projecting, how do you think that impacts this, forward PE ratio, and how do you think that impacts where your little quadrant, not little quadrant, I wasn't diminishing that, but your 2x2 build? How do you feel that impacts what the market will project stocks to do?
Yeah, and I'll just say first off, you and I don't make predictions. This is why, on an investment standpoint, a strategy standpoint, we invest and we hedge, because we don't try and pick tops and bottoms. We don't try and pick direction. But since he asked me the question, yeah, I mean, I think if the Fed funds futures curve is correct, what the market likes is a little more certainty. And I think if the market knows that it's not going to get any worse, i.e., rates are not going to go up this much, beyond this point, I think the market takes that as bullish. And if corporate earnings remain up, I think PEs expand. I think they expand from here. Market was pretty beat up. I mean, a lot of these tech names are off 30%, 40% from their highs. So yeah, to answer your question, when we have certainty, I mean, I always go back to 1994, Jay. 1994 was the last time, and I was in the markets during this year. Fed raised 300 basis points or higher. And the market was flat, and earnings went up 30% in 1994. If this year we're 8.5% to 9.5% up, okay, you have to have a discount then. But it was the next year in 95, the market did really well. And I'm not saying that's going to happen, but that's where I kind of sit. And by the way, I know we haven't even talked about the midterm elections. Markets tend to rally after midterm elections. I don't know what happens. I'll tell you in a year from now. That's where I see things, Jay.
Okay. Well, listen, I think that's the conundrum everybody's dealing with, right? Are these lower rates projecting, bad markets, bad economy, or are they projecting that the Fed has done their job? I think if it's the latter, where the Fed goes, okay, we've done enough, we see the turn in inflation, I think stocks are going to be able to rally from there, right? The old adage of don't fight the Fed is absolutely true this year. So, getting long, the market in the middle of an aggressive hawkish Fed can cause a little turmoil. It's a lot of the reasons we've seen the returns that we've seen so far this year. But if they stop, I think the fundamentals are there for equities to have a nice rebound. I'm not saying back to all-time highs by the end of this year. That would be kind of unprecedented to recover the full drawdown of 7 months within 5 months. I don't recall any example of that happening when we look at previous bear markets. But could I say in 2 years, 2023? Yeah, I mean, I think that it sets up nicely for a reset, and you'll start to see investment dollars coming in, and I think you'll see people willing to take more risks on stocks because fundamentally they're strong. They haven't showed the weakness yet. You see corporate earnings drop, right? I think EPS drops. Now you've moved to the bottom row in your quadrant, and not the most preferred scenario, right? Now you can technically have the worst case, which is dropping EPS and flat to higher inflation, which that's the one everybody wants to avoid. And I think that would cause some damage to the market if that did come through. But right now, that doesn't seem to be the case.
Yeah, I mean, what the market's betting on is we're not going to be the late 70s where it went on for multiple years, that it's going to fix itself in 2023. And yeah, I mean, I think these are all. And by the way, everyone said we're too high on forward P's. We're too high. They got their wish. You're 16.5 to 17 right now on a forward PE ratio. So congratulations, market. You did it. You got back to average.
Now what?
Yeah. Now what exactly?
Now what?
Yeah.
Now what do you want to do?
Tom Lee, by the way, I'll mention this very quick. Tom Lee has been bullish. Tom Lee's been pretty good on the market. So he appears on CNBC. He runs, I think his firm just does analytics, or, he sells research to institutions. I mean, he's predicting 4,800 by year end, which is very bullish. And he's always been pretty bullish. But, I mean, the consensus right now, I think is bearish. And I always like when the consensus is bearish to be a contrarian sometimes and say, maybe everyone's not going to be right. Everyone is normally not right. And the most obvious things that everyone thinks is going to happen doesn't happen. So I don't know, but I don't want to discount this midterm election thing. And maybe I'll spend some more time on that in another episode, but that's a real thing. When you have one party in power across the board in the first midterm election, you get somebody else, the House flips or the Senate flips, it means that they can't spend another $1 trillion on some program that's inflationary. And I think the market might look at that as bullish, Jay. So that's my thoughts there.
Yeah, the market likes a government that can't get anything done, right? Because it means less change and more predictability.
That's right. It's perfect. Don't do anything. Split government's normally okay for markets. So, All right, Jay, let's leave it there. We gave our recommendation for the bear. On my list too is it Blackbird or Blackbeard on Apple Plus TV? That's on my list. I haven't watched it yet though.
I haven't got to that one either. I have Dark Phone is on my list to get through this weekend.
Dark Phone? What's that?
I don't know. Some sort of a little bit of a thriller horror movie. Some people have seen it. It's I think that's the name of it. Black Phone, Dark Phone. Look, I can't even get the name right. My son will make fun of me for that one.
All right, Google
there you go.
some random color and phone, and maybe you'll find it.
I think it's Black Phone, actually.
Really?
Yeah.
The producer?
Yeah, I do. I think it's
not like the producer or the director is listening to this, but like, come on, really? You don't even know what you're going to watch? All right, well...
It's the way my weekend goes.
We'll keep an eye on that.
All right, Derek.
All right, Jay, thanks again. For everyone else, we'll talk to you soon next week. See you, Jay.